In April 2023, 1 in 5 Australians have a fixed rate mortgage that is set to expire between now and the end of 2023. If that's you, stick around. In this video, we're going to talk about what you can do between now and then to minimize that interest rate pain. As you know, over the course of the last 10, 11 months, the RBA has consistently increased interest rates in an effort to combat inflation. Now that has only impacted a certain section of the population that has a mortgage. Those that have variable interest rates have seen their interest rates steadily increase. And I say steadily, one of the sharpest increases that we've seen in history. However, over that 10-month period, we've been able to sort of adjust as time has gone on with these interest rate rises. As I said at the start of the video, there's 1 in 5 mortgage holders that are yet to feel that pain because they have fixed rate mortgages that they set 12, 24 months ago that are sitting around the 2 to 3% mark, so very low. And then as they expire, they're gonna go from 2 or 3% to around 6%. So let's have a look at some of the detail and then we can get into what you can do between now and then to minimize that pain. This week's housing statistics from the Australian Bureau of Statistics is showing that refinancing activity is at an all-time high. You've got people out there looking for better deals, moving between banks, so much so that almost $220 billion worth of mortgages have been refinanced in the year so far. In fact, only up until February 2023, so that's massive. Contrast to February 2020, that is basically double, that $220 billion is basically double the amount that was refinanced in 2020, just prior to the start of the pandemic. They go on to say here the refinancing activity is certain to increase for the remainder of the year, given the record volumes of fixed rate mortgages that are scheduled to expire between June and December this year. So let's have a look now at the chart here from the Australian Bankers Association. And this goes to show here quite clearly that between April and June, there's a huge amount of people, 222,000 people, that are gonna go from a fixed rate mortgage, which is sitting around the 2 to 3% mark, they're gonna roll off and their interest rate is gonna be somewhere between 5 and 6%. That's massive. And as the year goes on, you can then see here, there's hundreds of thousands of people every couple of months that are rolling off and their interest rate is going to essentially double in most circumstances. So there's a lot of people out there, hundreds and hundreds of thousands of people out there that are yet to feel the pain of these interest rate hikes. So what can you do between now and then if this is you that has a fixed rate mortgage that is going to expire later this year? There's a couple of things, but firstly, I want to look at the cash rate futures, because this for me is a good indicator for what we can expect interest rates to be at a certain point in time. Now, this is obviously indicative. It doesn't mean this is exactly going to be the interest rate at the time, but it gives you a good indication of what people are expecting, the markets and the banks are expecting the rates to be. So we're here, obviously, April 2023. You can see the RBA official cash rate is sitting at, well, just above 3.5%. Between now and September, you could probably say that things are going to be relatively smooth based on the current market conditions. I would say that the interest rate or the cash rate is probably just going to stay flat all the way through until sort of Q3, Q4 this year, when we'll start to see it drop back again. So for those of you rolling off between now and the end of the year, the current variable rate is what you could expect to be paying when your fixed rate term expires. So this is just a good indication to kind of expect, okay, rates aren't going to be the cash rate's not going to be 5, 6, 7%, at least from what we can see right here. It's probably going to be consistent with what we have out there in the market today. So what can you do between now and then to minimize the pain of that interest rate hike? The first thing that I would recommend is, and this isn't financial advice in any way, this is just generic information that I'm giving out, but you want to basically be spending as though your rate is 5.5%, 6%. If you're not doing that already, what you want to then do with the spare cash that you're going to have saved is a couple of things. Firstly, if you have credit card debt, you have personal loans or student loans, you want to get rid of those, or at least pay them down as much as you possibly can, because this period of time where you have excess cash, so to speak, at the end of each month, you want to be putting that into all of this personal debt, because the interest rate on credit cards and personal loans and those things is generally much, much higher than what you would be paying on your mortgage. So act as though the rate is around the 6% mark. Use that cash if you have credit cards and personal loans to pay down that debt. If you're in the circumstance where you don't have credit cards that have an outstanding balance or personal loans or that sort of thing, you want to basically get that cash and save as much of it as you can, so that when your fixed rate mortgage expires, you can then use that cash and put it into an offset account to offset the interest payable on your loan. That is if you are going back to a standard variable rate. So most banks, if you don't know, will allow you to have an offset account attached to your variable rate home loan, and any money in that offset account is going to offset the interest payable for your home loan. If you decide to go and fix it for another term, generally you're not going to be able to have an offset facility attached to your fixed rate mortgage. But nonetheless, a good point to know if you want to go back to the standard variable rate. Importantly, once your rate expires, even now, start shopping around. There's loads of banks offering cashback offers if you refinance with them. You might get a couple of $1,000s to switch your mortgage across to another bank. Keep in mind though, refinancing, there is some cost involved with that. That's why the banks offer you this cash back to fund the costs of mortgage discharges and all those sorts of things. So keep that in mind. It's not entirely free when you go to transfer your mortgage across, but shop around. The banks are very competitive right now, and get a good deal for yourself. Put some cash aside, pay down some of that personal debt that you have. If you don't have it, put the cash into an offset account so that when you go to a variable rate loan, you can offset the interest as best as possible. But look, the interest rate pain is inevitable for all of us at some point in time. But as you could see here on the cash rate futures implied yield curve, the rates right now are probably, from what we can see here, going to stay where they are, at least for most of this year, and should start to decline as we get into 23 and 24, depending on the global market conditions, depending on that dreaded R word that gets thrown around quite a lot. If we go down that path, then I would expect that rates would start to tumble quite quickly. So hopefully that's helped some of you out there that have fixed rate mortgages that are set to expire. If you've got any questions, hit me up on my website, smashthecycle.com.au. Book yourself a free session. We can have a chat around how I can help you and your personal finance situation. Until next time, thanks for watching. I'll catch you soon.